Hello and welcome to Author's Note. We're here to talk about the value of banks. With the financial crisis over 5 years old, huge arguments still rage in economics and markets. But one thing we can all agree upon is we're far from out of the woods. Banks are a classic example, and I'm delighted to say that with me today to talk about banks' health and their future is Andy Haldane, who's in charge of financial stability at the Bank of England. Now, let's have a look at the first chart we've got here. This is a chart for the UK, the US and European banks of their price to book value. Can you first explain what are we seeing here? What does price to book value actually show?
So Chris, this is measuring the value of a bank's equity as perceived by the market relative to the value of that equity when it was first subscribed by shareholders. This is the market's guess of how much they might get back by putting an extra pound or dollar into a bank. What this is also capturing is their future profit streams, how profitable we might expect them to be looking forward from now.
So here we can see that we were very optimistic in all markets for most of the last decade, and then there was a rupturing.
Well, this is quite a roller coaster, as you say, Chris, over the last 20 years or so. For a good amount of that time, banks were valued above the book value of their equity. Investors' expectations were that they were a money machine, that they would create additional value for shareholders, which is why the price to book was above 1 and why money flooded in from investors to those banks. We saw the biggest banking bubble possibly ever on the back of these sorts of valuations.
And just so let's see what happened 2007, 2008. We go from a price to book value in all the big areas of about 2 down to about 1, down to about half, then a little recovery back to about 1, so as if banks were fairly valued, and then more recently back down well below 1. So what's that telling us? That the markets are saying that banks aren't worth as much as the accountants are basically saying?
Yeah, I think there's two things going on. One message from these ratios is, as you say, Chris, which is that banks' legacy portfolio might be worth somewhat less than the accountants are currently measuring them at. There are good reasons for that. We know that forbearance on loans on banks' balance sheets is pretty widespread right now. And we know that accounting rules prohibit banks from looking through to the future to what future loan losses might be. That would both tend to deflate the market's guess of what this bank is truly worth below its accounting value.
And if we take a look at the second chart, so this looks at individual banks, we see that not all banks are alike. This is sort of more recent history. We see again the fall. But if you look just at the right-hand side, we see RBS sort of at the bottom of the league. So that suggests that the market believes RBS has big write-downs to come, presumably, whereas HSBC pretty much at book value. What do you take from this?
Two things. One, as I say, is the message that you just mentioned, which is that for some banks, they are still sitting on a legacy portfolio, a back book, that is somewhat overinflated relative to what the market thinks that might be worth. That's one factor. I think as important a factor, though, Chris, are concerns among investors about what the future franchise value of these universal banks might be. What they've seen over the last 2 or 3 years is that these things are fiendishly complex to manage, to supervise, and ultimately to price.
And so this might mean, might be a signal from investors that banks should maybe break themselves up to maximise their own shareholder value. Can you take that from this?
So the evidence is certainly consistent with the banking sum being less than each of its parts, or put into your terms, that value could be extracted by selling these asset units separately. And that's why I think proposals of a structural nature to ring fence, to separate the Volcker, Vickers, Liikanen proposals might actually be value accreting for investors. What's killing them right now is the uncertainty, the complexity. If ring fencing or separation removed that complexity, removed that uncertainty, that could actually be net good news for investors.
Well, thank you very much, Andy. That's an intriguing thought to be left with, that perhaps if banks did what they claim they don't want to do and break themselves up, that might be in their shareholders' best interests.